This is the Retirement Solution Podcast with financial advisor John Hicks, founder of J. Hagan Capital.
And I'm Heather Branch here with John to ask for his insight on ways you can better prepare for your financial future. RetirementSolutionRadio.com is where you can go to start your own conversation with John and his team at J. Hagan Capital. We also have links posted in the show notes, so you can just click there or again find us anytime at RetirementSolutionRadio.com. Let's talk about the inverted yield curve.
Ooh, that's pretty wonky.
I know.
Yeah.
So one of the signs that we're headed for a recession is just that. It's called the inverted yield curve. Yeah. And help me understand this.
It's when short-term rates give you a higher percentage yield than long-term rates. So basically, if you get a 1-year CD, you're going to get paid more than a 5-year CD.
Okay.
Inverted yield curve.
And that's what's happening right now, right?
Yeah, it's been happening for, I don't know, let's say the last 9 months or so.
And that's because of higher interest rates?
Yeah, so when the Fed moved everything up to control inflation, they threw everything in a tizzy. And so short-term rates are right now more expensive than long-term rates because the expectation is that we can't keep rates this high.
Got it.
I mean, there's no way we can sustain this. No industrialized nation has been able to sustain inflationary rates the way that we had it unless they have a major failure or they have a currency crisis or things like that. No one wants that, right?
Right.
So the whole objective is that everyone feels, hey, maybe it's not going to be this year, but within the next year, certainly long-term rates and short-term rates are going to both come down.
Okay.
So,
what's interesting is that traditionally seeing an inverted yield curve means we're headed for a recession. However, maybe not this time around. Analyst Ed Yardini was telling Yahoo Finance that he does not think that it's going to happen right now or in the next year or so because the Federal Reserve did actually act properly.
And this notion that an inverted yield curve means that we're going to have a recession, what it really does is it predicts a process. It predicts a process that if the Fed continues to raise interest rates, something will break in the system, and that will lead to a credit crunch. And it's credit crunches that cause recessions. Well, the yield curve got it absolutely right again. And we did have a financial crisis last year, but the Fed came in and played whack-a-mole. That they whacked it right down with a liquidity facility, and we didn't get a credit crunch, so we didn't get a recession.
This is very interesting because, I mean, can we say that our government actually got something right? I want your opinion on that.
Well, what I just heard is he just said that they played whack-a-mole. That I totally agree with.
It's not very reassuring.
Yeah, whack-a-mole. It's like, getting it right.
Like, let's see what happens.
You whacked the right mole that one particular strike. So I don't know. I don't know if this is going to pan out and be correct.
Okay.
Yardini said something very interesting, and he said that credit crunches are what cause recessions. That's a partial piece of the puzzle. But when you think about it like this, ladies and gentlemen, it's been a little while since we had a real recession.
Right.
You have to go back to COVID, which lasted a whopping 2 months.
Right.
And it was not a recessionary
It wasn't even
environment.
real.
No,
it was just everybody panicking because of the world.
Of course, because we had not been shut down for over 100 years.
Right.
It was the Spanish flu from the 1900s, early 1900s, that was the last time that we'd really ever experienced anything like this. And so we just didn't know. And of course, now we had all these televisions and 24 hours news channels, propagating the fear and all this stuff. But when you look at it, it's been a little while since we've had a recession. The market's kind of gone, through the roof. And remember, 2022, we had a rough year in the markets. That was a bear market. I don't really know because remember, I've been griping on this show for 2 years. They keep changing the definition of a bear market in a recession.
Right.
So they kept telling us, we're not in a recession. We're not in a recession. We're not in a recession. So I'm going to now hold them with their own words. We were not in a recession in 22. That's what they tried to promise us and tell us. So let's go ahead and go with their vernacular and say that we weren't in one. Well, that means that it's been quite some time since we've had a recession, and the markets are pretty expensive.
Right.
So what does that mean? Frankly, here's what I'm going to say. It doesn't mean anything. In the long term, it doesn't mean anything.
Okay.
And here's the reason why, Heather. When you think about recessions or bear markets, since 1957, there have been 39 bear markets.
Okay.
Now, what does bear market even mean? It means the markets go down 20% from the high point.
Okay.
And they can stay down for 3 months or 6 months. The average is around 10 months when markets go down. Now, this does not mean a bear market does not necessarily mean a recession. Now, the reason I'm saying this is because this is very important, and it's how we react to things as human beings.
Okay.
It's how we react to news, and it's how we behave in retirement, where this can cause us to screw up, even if it's not a recession. So that's why I want to make sure we all understand this, because this is kind of important stuff.
Okay.
When you talk about the things that we should do to invest wisely, the average bear doesn't do anything near that. They do things based on
Emotions,
guts and emotions and media and neighbors and things they've been told.
Water coolers and that guy that sits next to you in the office.
Facebook and LinkedIn and whatever their kids say. And I have to laugh. I just have to laugh because I'm like, yeah. So maybe that'll work out, maybe, and just like maybe this time the Fed got it right, maybe.
Okay.
But when you think about it, when you get to that point where we're going to retire one day, we're thinking about it. We're 3 years out, or maybe we've already retired. Either way, things are a little different at that point in time, right? And here's why they're different. Because no matter if you're working or not, you're probably going to have to live off some portion of your money. And chances are you're going to experience 15 or 20 bear markets over the next 25 to 30 years. There's just a great chance of that.
Okay.
So whether or not we get it right this time, the likelihood of being right the next 20 or 25 times in a row
every time,
is really probably not very good. I think there was a better chance of people picking 100% every single game right for March Madness and the NCAA tournament this year than there really would be to call all of the bear markets and the recessions during the course of their retirement.
Got it.
So this is why we used to talk a little bit more about that stuff on the show, and now I've realized there's no point. It literally is pointless to try to guess on what's going to happen next in the market. As a matter of fact, it makes zero difference if we do one thing wisely. If we focus on the things that we can control, our chances and probability of success go through the roof.
Okay.
But if we focus constantly on news headlines and what our neighbor's doing and what the Twitter machine says and da-da-da-da-da-da.
Which so many of us do. We're so many of us are smart people, but we fall victim to the hype.
It's hard to stay away from it, right? And we just assume, hey, if this is what the smart people are doing. But the point is that no one says the smart people are doing that just because it was reported. It's just information. And the question is, how are we going to assimilate that information in things we do? Here's my point. We probably shouldn't very often. When we think about the things that we can we control what we spend on a daily or monthly or an annual basis? Well, if we're thinking about retirement, we kind of have to, right? Because if we ever want to quit punching that time clock, we're probably going to have to make certain that we've saved enough money where our Social Security and our savings can provide for us an income, and hopefully we get some other part-time work or a third or a fourth income source where they can provide income so that we don't have to worry about work anymore, right?
Yep.
So if we have that money coming in, there's really just one major thing we have to do. We got to figure out how can we consistently create that income stream so that we can live for the next 15 to 20 years. Okay. That's really what it boils down to. Now, in my firm, when we're doing the math, we want to go much further out. We want to go for the life expectancy of the person that's probably going to live the longest. Often with a couple, it's often the female. So we know the life expectancy may be 3 or 4 or 5 years longer. So we're typically pushing our clients out to 90 to 95 years of age. But we also want to make sure there's going to be money left over even then in case we lived older than Methuselah, right? But the objective is to make sure that we know where that income is going to come from. Are we going to have a guaranteed pension? That's fabulous. Are we going to have an income source where we can rely on that bank interest or that bond interest or that treasury interest? Do we have an insured account that is guaranteed to pay us for a period of time or for the lifetimes of not just one person, but for both? So however we create that income, we want to make sure that it's consistent, it's stable, and it can last for the expectation of our retirement. Because then, once we understand that income stream, we want a different bucket of money to be growing to offset inflation, to offset tax needs, to provide for the kids and grandkids. And this is a big problem. Most people think, oh, I need all my money to give me income. And I need all of my money to grow. And I need all of my money to do. No. Ladies and gentlemen, that's how you will fail. You will fail if you think that every asset you have can do all of those things. As a matter of fact, we know for a fact the majority of assets are only good for one thing exceedingly well, and maybe get a little lucky to do something else. If we have something that we have wanting to grow, it is very hard for that growth instrument to also produce a proper income stream. If we have a really great income stream, it's really hard for that sucker to grow a lot as well. So it's better if we isolate those two styles of investing so that we can take a lot of the stress off the portfolio. The portion that's built to give us an income, like a pension or Social Security, then let's let it do that for us. And the portion that we want to grow, let's don't dilute it. Let's go with the best growers in the economy. Let's go with the best thought leaders and the artificial intelligence and the proper catalysts to grow the money the most. If we do that correctly, not only do we have a much better chance of hitting our goals, but we're going to be able to sleep at night because we know where our income's going to come from. We know it's going to grow. We know how we're going to be taxed, and we can live to fight another day, whether the recession happens tomorrow, next week, or 5 different times in the next 10 years.
RetirementSolutionRadio.com is where you can go to begin this conversation with John and his team about your retirement savings and investments. We also have links posted in the show notes, so you can just click there or, again, visit us anytime at RetirementSolutionRadio.com.
Thanks for listening to the Retirement Solution Podcast with John Hicks. Begin the conversation about your savings plan with John and the team at J. Hagan Capital by visiting RetirementSolutionRadio.com. Be sure to listen to John's radio show, The Retirement Solution, Saturdays at 8 a.m. and Sundays at 9 a.m. on News Radio 840 WHAS.
J. Hagan Capital Inc. is not licensed in all 50 states. To find out if J. Hagan Capital Inc. is licensed in your state, please call 502-690-5635. J. Hagan Capital Inc. is not affiliated with nor endorsed by the Social Security Administration or any other government agency. It does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Jonathan Hicks, insurance license number 548962.